This webinar is recorded and will be uploaded to Admiral Markets website. So how to manage your trade by profit stops, how you can turn your trade from a scalp into a intraday position, and generally when you see volatility, how you should behave. Of course, when market is a bit calmer as it was today and yesterday, you can basically use bigger profit stops, but I will explain how to use tighter profit stops when market is very volatile. You have probably noticed that our last session recap trade gave like 180 pips of profit, but it hit our target definitely. So you probably made excellent profits, and that is definitely what we will discuss on Monday. Today, as I say, is a day for our trailing stop buy profit. Before we begin, our standard risk disclaimer explaining that online education materials are available by Admiral Markets in Estonia. They're meant for a global audience, and you should take into consideration the information in this session may not be suitable for everyone. And if you want to get a corresponding information on charting conditions and any other detail, you should visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. Final part of risk disclaimer is saying that Admiral Markets UK Ltd takes no responsibility for the information accuracy, and by accepting the rules, you're also proceeding further with me. So today's agenda: advantages and disadvantages, stop loss techniques, and live chart examples. So we will go through advantages and disadvantages of stop loss placement, then various stop loss techniques, and finally we will move on to live chart, and that is when I will show you how to manage your trade by profit stop. So there are a lot more advantages of using stops, and I will tell you most important of it. So by using stop loss, first of all, you will be protecting your equity. You will be protecting your equity, guys, all the time, because if you don't want to use profit stops, then be ready for a possible margin call eventually. The thing is, the tide of luck can turn anytime. So remember that Forex market is very volatile, and if you don't protect your trade by using stops, you're effectively not protecting your money, your own money, right? The thing is that why it's called stop loss, because it's stopping your loss. So it stops for your trade from a further loss. That is why it's called stop loss. It's good that it exists, and it's good that you can basically place it also manually. That is what I will teach you today, how to use profit stop by manual placement, no robots. Now, if you don't use stop losses on leverage trades, that will definitely end your career in Forex market if you don't have any money to invest further. The thing is that it will give you the peace of mind, because you know what is the greatest peace of mind when you're trading? That you don't need to be nervous, that you're not sweating when your trade is running, that you don't bite your nails, and you don't drink any alcohol while you trade. That means that you are basically trading a very calm, very easy, and with peaceful mind. That is very important, because if you're not calm, if you're not peaceful, that can lead you to, you know, that already probably revenge trades, over trading, using a huge leverage, basically over leveraging your revenge trades, which is the definitely the most dangerous thing. Just imagine using a huge over leverage on a revenge trade. Usually what happens is you will lose it, and you will lose much more than you originally uh, you had a plan for. And remember, guys, your plan should always tell you how big is your risk. If you're not going with a plan, then you effectively are not a serious trader. Because if you decided to that your risk is 1 or let's say 0.8 or 0.5% per trade, why would you use 3% or 10%, 20% per trade? Why? What is the logic in that? There is no logic. The only thing is you have a gambler's mind and you definitely want to gamble. That is the only logic, because you want to recuperate for your losses by over leveraging your revenge trades. Okay, so you are basically making two sins, which we already mentioned in our Forex blog. You're making two sins, which can be very deadly to your account. Stop losses are disconnection proofed. Sorry, and stop losses will definitely be placed also on the server side, because when you place your stop loss on the server side, even if your PC is disconnected, your stop loss would be respected. That is very good thing. Just imagine what would happen if there is a sudden 500 pip move opposite to your direction and you don't have any stop loss placed. Just imagine what can happen. So that is why you need to use a disconnection proof. That is a stop loss placed on your platform. No matter if you're trading from your PC, from your Mac, from your Android or iOS phone, it's always disconnection proof because stop losses are placed on servers. It's also platform malfunctioning proof. For example, if PC freezes, it doesn't matter, your stop loss will still be respected. Now, disadvantages are really less. Psychological failure when stop loss hits. Okay, guys, lower your leverage. If you lower your leverage, the impact of psychological failure will be low. Remember that. Will be very, very low. Because guys, if you don't trade with a huge leverage, sometimes you don't need to place it immediately when you place a trade. Okay, but if you use a bit of leverage, then you need to place it immediately. For example, if you have $10,000 account and if you trade with 0.1 lot, even if 300 pip move suddenly happens, it will not have a big impact on your account because you will lose only 3%, right? That's nothing. That can be easily recuperated. But the problem is if you are trading $10,000 account and you put one full lot and there is a sudden 300 pip movement opposite to your direction, then instead of 3%, you will lose 30%, which is a big loss. 30% in a single trade is unacceptable. That is a huge loss, and that is what a lot of traders really have problems with, because that psychological failure of the trader's mindset will trigger on an over leveraged trade without any stop loss, let alone revenge trade. Because revenge trades are done, those are psychological trades. They don't follow any logic in that. The only logic is I will go with the flow until my account is margin called. Well, that is what you should try to avoid all the time, and you should never let it happen. Okay, if you want to trade $100 account or $200 account, I always say, guys, you can experiment with it. It's not a lot, you can afford to lose it. But if you trade with 10,000, 50,000, $100,000 euros accounts, that is what you should really be very careful. No matter if you have the money to cover it, if you have I don't know, millions, it doesn't matter still, because the impact of losing that huge amount of money in a single trade is huge. That can disturb you as a trader. So disadvantage is not huge. It's It's a very, I can say, acceptable disadvantage, because that psychological failure has to do with your inner self, not with maybe you're a great trader, but you just don't have that trader's mindset. You have a gambler's mindset. And I know a lot of traders who are good one, but they have a gambler's mindset. Remember, if you lose 3%, 10% of account, it's okay. You can manage it. You can manage even 30% of a loss, but not. It's very hard to manage 30% of a single trade loss. That is what it draws a lot of different things: psychological failure, revenge trades, over leveraging, then impatience. Because when you lose a huge chunk of money and chunk of account, it will definitely lead you to being impatient. You will rush for a trade. You will chase the trade. You will chase the market. Okay, you don't. Definitely, that will ruin you. Now, also another disadvantage if it's placed in a wrong place or time. So you just don't know where to place your stop loss, and you can ultimately suffer from a death of 1,000 cuts. That means constantly trading with small stop loss it can get hit each time when position is opened. And instead of letting your trade have some buffer to your stop loss, that is why we use 50, 60 stops on our session recaps. We don't want to suffer death of 1,000 cuts, because if you constantly trade with small stop loss, it can happen, and it will inevitably happen. Believe trust me, guys. Have trust in what I'm saying, because most of these things I'm telling you from my personal experience. In my trading career, I have also tried to experiment with low stop losses. I don't know, 15 pips, 10 pip stop. It's impossible to trade with so low stop loss. It won't happen maybe today or tomorrow, but in near future, it can really cause a mayhem to your account. A huge, huge drawdown, or let alone margin call. So instead of making intraday, I don't like to scalp really, because scalping is, I don't know, it doesn't have good risk to reward. But there is a remedy to it. I will show you today. You can move your profits when you're scalping. So that is the only remedy I have known so far. But I personally don't like to scalp. So scalping is like 5, 10 pips of profit. It's too low really. It doesn't yield a good risk to reward. Better thing is to try to focus on scalp swings or intraday positions where you can make 30, 50 pips, even 20 pips, much better than 5 pips. So methods for stop loss placement are so-called ATR stop, percentage stop, confluence or technical stop, and the final part is profit stop. But in order to place a profit stop, you need to use one of these three things. Usually profit stop is connected to a confluence or technical stop. So this is how we use the ATR stop. You need to place ATR 14 indicator on your chart. It will add, basically it will show you high ATR to low ATR. So if high, look at this example here. If high ATR is 68 and low is 23, you basically need just to multiply it with 25. So add 61 to 23 and you will get 91. Multiply 91 with 25% and it's 23. So let's say that you use, for example, 34 SMA. It doesn't matter. You use MA. It doesn't matter which MA. So that means that you should place stop loss of 23 pips and spread below your MA. This is usually done when you are trading with MAs, with moving averages. Okay, it's not last swing high, it's not last swing low. So usually it has its logic when you trade with technical stops. So what you need to do once more, place an ATR of 14 on your chart, add two numbers which you see, high and low. It will always show different numbers. So in this example, it's 68 and 23. Then the given sum is 91. Multiply that sum, it's 91, with 25%. It's 23, right? Add your spread to 23 and place it below moving average. It's called ATR stop. So this is the example. Here we can see 14 and 3. 14 plus 3 equals 17. 17 times 25% equals 4. So we need to place stops 4 pips above last high or EMA. Usually it's EMA, but it can be also last high. But usually, as I say, it is applied to EMA. Okay, so this is how you can decide about your ATR stop. So this is the method for ATR stop calculation. Percentage stop, it's also frequently used by some traders. It uses predetermined percentage of traders account, let's say 3%, not referring to 3% per trade. It can be 3% per day. So if you want to make 5 different trades, you should split the risk between those trades. With this method, stops are usually small if trades are leveraged, because leveraged trades will not have a huge margin for error. There are no many entries, it's usually a single entry. So if you want to use 2 or 3% risk per single entry, usually that will be either a huge leverage or very tight stop. Not many traders do that because it's arbitrary stop loss. You're just you don't use technical or ATR stop. You just want to try to exploit arbitrary stop loss, and that can be dangerous. Typical stops are 2% for intraday trades, 8% for intra-week trades, 15% for monthly trades, and 20% for investments. Some people use 30% for investments. So this is just an example. It doesn't matter which currency, which pair. If a long trade is entered at 1.250, a 2% stop loss would be placed at 1.225, 25 points lower than the entry price. So it's just an example, but you probably know how big your account is and what you should afford. I don't use percentage stop, and I don't recommend you to use it. Really, I'm not recommending it. Confluent stops. We need to chart trend lines and fibs. That is important. We should also use pivot points. Determine the best confluence and place stops 5 pips above the confluence point. It's connected to technical stops. For example, we see basically A, a trend line, B, a Fibonacci number. Here is Fibonacci number. C, longer term trend line. D, historical support resistance level, and this is Camarilla, okay, old Camarilla which I used. This is our entry. So based on that, guys, you can decide to place a confluence stop. Very tight stop, conservative stop loss would be, aggressive stop loss would be just above this high. Now, conservative stop loss would be placing it above this trend line. So here we have a confluence of Camarilla pivot, a trend line, and previous high. So by placing our stop loss somewhere around here, you can say it's placed above last swing high. Now, if you have a trend line above your first confluence, then you could probably place your stop loss a little more conservatively here. So that is how you place your stops. So by finding previous swings, highs and lows, by placing your trades above various confluence points. Okay, this is important now, this introduction to stop losses, because uh, you need to know all of this in order to be able to move your stops in profit, so-called profit stop. So once more for Confluent stops, a summary. We need to chart trend lines and fibs. We should also use pivot points. You can use Camarilla, you can use daily pivot points, weekly pivot points, whatever you choose, you deem it's good. Determine the best confluence and place stops usually 5 pips above the confluence point. Also, we need to move our stops when we are in a trade. Now we're talking about profit stops. So that is a manual stop loss placement. So I don't use any trailing stop expert advisors because I trail it manually. That way we can turn a scalp into an intraday position. It's very effective when market is volatile, because when market is volatile, your profitable position can suddenly turn into a loss. And it's useful, guys, in all time frames. It's very useful in all time frames. So let's see how we do it on a live chart. Now I will open CBT template. CBT template is, channel bounce system, which I have explained you already. If you don't know which system is this, you can refer to our webinar. It's channel bounce. And just for example, I can show you how you can do it. Of course, I don't know which systems you use for trading, but the thing is, the logic and the principle is the same. The logic and the principle of this. I will use just for showcase purposes, for this webinar sake, I will use CBT template to show you. You can see euro dollar. It's going straight to our target, which is 110.50. So if you've been trading euro dollar after our session recap, it definitely goes in the direction I predicted, and I'm not surprised at all. So let's see how it goes. For example, we have initiated our trade at this point here. So this was our signal to go long, or let's say this one here. This candle was a signal to go long, and you can see, for example, that next resistance is definitely somewhere around this region. Now, how I do it usually, I see that the trend is really strong. It goes up, then down, it's a pullback, then it goes up, 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 and up. And you see this candle here has broken through our resistance. In this example, it's a manually drawn line. It can be also a pivot point. It doesn't matter. It can be a pivot point. It can be next support or resistance. So when this level breaks, price should usually proceed further or be rejected. Now, if you see an initial rejection, you can use previous candle low for stop loss placement, effectively moving your initial stop, which was somewhere around here, right? If you use Confluence or technical stop. So you just move your stop loss here. You can also use on Admiral Markets platform, you can move your stop loss line here. You don't need to type your stop loss in. You just need to move the line. Press left mouse button and move the stop loss line here. Now, in this example, you can see that the price has made a Marubozu candle, which is a momentum candle. So it suggests that momentum will be strong. It's a logic, right? So what I would do here, I would move my stop loss exactly 1 or 2 pip just below 34.08. And next candle, you see the low of next candle is 32.14, and it proceeded to go up. You see? So our stop loss here has been moved. So instead of keeping it the same here, we just move our stop loss, and that way we have secured a free ride. It's called a free ride. 50 pips of profit. So let's say that next resistance is just, for example, here. Now the price has went here, broke through this resistance, and you move your stop loss from this point, guys. This is your stop loss. Move it 2 or 3 pips below previous low, which is, this is previous low, right? Previous swing. And now in that point, you have secured another 80 pip, which is 120 pip here. Okay, it's 120. If we go with our entry, 135 pips. Now, of course, this will not always happen. This will only happen when market is very volatile and trend really goes and favors your direction. That is how you do it. For example, pound dollar trade from our session recap webinar, we have made our entry at 49.60, guys. Look at this, almost no drawdown. This was far the best trade of all session recap trades so far. This was an absolute blast, a killer trade we call it. So let's say that you have made your entry here, and at this point you saw that there is a strong resistance, right? Now the price has made it here, broke through resistance, and you probably placed your stop loss below last low, let's say here. So effectively you have secured 70 pips of profit. And I advise you to use 1 hour time frame for this, because 1 hour time frame is optimal. So this is where you moved your stop loss. Then you saw that the price is indeed going towards our target, which was 51.40, but you saw also a resistance here. So this candle broke with a huge momentum up this resistance, and you move your stop loss from this spot, you move it just below this resistance here. This is the logic for profit stop movement. Now it's up to you whether you will close your trade after 20, 30, 50 pips, whether you will use break even, or this way how I show you. It's up to you. Some traders prefer to do it like this. For example, once this resistance has been broken, they move their stop loss here to break even. They want to have a margin. Now I know, because if you made 100 pips, it's very hard to place stop loss on break even. You would rather close the whole trade completely after 100 pips, not move your stop loss, right? So that is what I'm saying. When you see this type of candles, breakthrough resistance, just move your stop loss below last low, which is definitely here. Or you can be aggressive with that. You can even place your stop loss here. It depends, guys. It's not strict. It's not that you must do it. So you can either place it here, or I would probably place it here. So I would be securing like 70 pips, which is great, right? So the margin for profit stop is bigger. If you placed it here, this candle could easily spike your stop loss out, not giving you a further move. So it's up to you how you will manage it. The logic tells us, okay, this is a hammer, right? and it goes straight from support. So we could even place our trade stop loss somewhere around here, and we would be safe. But sometimes those trades will not listen to us. For example, look at this. For example, just for example, you wanted to trade short at this spot here, okay? And you want to take a short trade. This is probably, yes, this one is, let's say, important support. This one, important support. You have initiated your trade here, right? So your trade was initiated here. Your stop loss is probably somewhere here, where I marked it. So your trade goes quite fine. It goes straight to support. But then suddenly a trade jumps. Now what to do? I would probably place my trade here at this swing point, and I would have been stopped out. This will frequently happen, but at least you have secured your profits. So sometimes this will happen, so you secure 40 pips. But you see, if you moved your stop loss to break even, you would have been stopped out here. So instead of 40 pips, you would have taken nothing. If you moved your stop loss to break even here, see, it's a spike, and then it went down. So you see the spike. This is the spike. This is stop loss spike. All stops which were collected here spiked out to the upside, and the trend was resumed. Let's say that you have taken your entry here, this congestion point to the downside. Of course, your stop loss is placed here, initial stop. The trade goes in your direction, down, down. This is next support right here. This is next support. And you see the candle is breaking through support. Now, probably I would place my stop loss here. And effectively, I would secure at least some pips. I don't go any time below 20. So this is not 15, so this is 20. I would go like this. Okay. Like 20 pips, right? And that way, you see, I'm still in a trade here. This is my stop loss line. And eventually, before hitting final target or support, I would move my stop loss here. So I have secured my pips. So that is, guys, how we do it. It's very easy. You don't have anything to worry about. Now, obviously, this principle works even when you want to scalp. So let's say that you want to take a trade on 5-minute time frame. You want to take a scalp. It doesn't matter the system. The logic is the same. So you want to take a trade here at this point, right? Here. You want to take a long scalp. Now, when trade goes in your favor, let's say 10 pips, which is okay for a scalp. 10 pips usually, scalpers take 10 pips. Okay, 10 pips is here. You can apply the same logic. But the margin for stop loss is not that big. If you have a string of luck, really, and Lady Luck smiles upon you, you may see additional momentum here. But if you do it as a scalp trade, the chances are you will be probably stopped at break even. For example, this trade. If you have traded this scalp trade, the same, you would probably secure 10 pips. Okay? So you see, this is the spike, your entry is here, you place your stop loss here. And you probably secured a lot of pips with scalp trade. But that won't always happen, because it's not you or me who moves the market. Those are institutional players, big money, big sharks. And you don't know whether the spike will be huge or it will be small just to take your break-even trade with you. So you see this example. So let's say that you want to take 10 pips. Okay, you made even more. Now just move your stop, which is probably here, to this part here. And your scalp trade instantly turned into an intraday position or a scalp swing. See, it's now 14 pips. So it's not a scalp anymore. It's more like a scalp swing. Okay, your initial scalp goes fine. It breaks this resistance. So you just need to move your stop loss. From this part, you can move it just below previous low, which was here. And now at this time, you are effectively securing 26 pips, which is now intraday position. And finally, you see, you probably secure every single pip if you waited here, because this was a spike to the downside, collecting some stops. So that is how you move, guys, your trades in profit. That is how you use so-called profit stop. Now, if anything is not clear, go ahead and ask me, because I think that I really made it this simple enough. Try to practice it. It's not hard. You just need to babysit your trade. Well, that's unfortunate. But even, guys, longer term trades, it doesn't matter if you trade 4-hour time frame. You can do the same on 4-hour time frame. It doesn't matter the time frame, because the logic is the same. The logic is the same. So let's see, this is 4-hour time frame. Okay, your initial stop loss is here. Okay, not there, but a little bit above here, let's say, like this. Then the trade goes in your favor. This is important support. Okay, you don't close your trade. You place with a previous swing high, which is this point. Okay, so you have secured your pips. Next support is here. Okay, so the trade goes in your direction and you move your stop loss here. Okay, and you're stopped out. But you are stopped out, let's say, for, let's say, 160 pips. This is, Jack is asking, what are your feelings about dynamic trailing stop? I don't know what dynamic trailing stop is. This is how I do it when I try to secure my intraday and intra-week positions. So this could be a dynamic trailing stop, but I call it profit stop, because your stop loss is placed in a profit. This way, how I do it. When I do it automatic moving stop, I don't do it. Jack, I never do automatic moving stop. Really, this is because I really want to, I cannot say babysit my trades, but I really want to follow the charts. So this is why I always use support and resistance lines. I use EQ pivot points or Camarilla pivot points, it doesn't matter. But the thing is, when important pivot point, I don't know, guys, how many of you have been following my EQ pivot point Twitters. Usually when I post a tweet on Twitter, EQ pivot point table, please take a look at it, because it's very, very accurate. EQ pivot points have been, so far as I know it, they have been the most advanced standard daily pivot points. And this is what I use instead of Camarilla. For example, if I use it on intraday charts, I can compare Camarilla and EQ pivot points, but EQ pivot points have good potential just for those intraday trades, because those are intraday pivot points. And that is why I'm telling you, you can just watch these lines, and when price breaks the line, you are effectively switching to higher time frame, let's say 1 hour, and place your stops below or above previous swings to secure your profits. On session recap trades, we never do it below 20 pips. Remember that. So when you're in profit from session recap trade, it should never be less than 20 pips. Never, ever. Remember that. And by using this approach, I think that a lot of your trades will end in profit. Especially if you want to sleep. So when you go to sleep, use this logic. It will save you. Very occasionally, it happened to me. If I didn't use this approach, I've been stopped out. Instead of being stopped out in profit, I was stopped out in a loss after Asia session. So that is when I decided every time to use a profit stop once I'm in a profit. Munira is asking about RSI low stop. I don't know what is RSI low stop. I use ATR stop, for example. I showed you ATR stop, but RSI low stop, I don't use it. Don't know about it. I'm a little bit conservative when it comes to stop losses, so I really tend to watch over my trades and move these lines accordingly. Okay, guys, I don't see any further questions, so thank you for listening. As I say, this webinar is recorded. It will be uploaded. Try to implement this logic. Of course, this also will be a part of our price action training school, so we will be mentioning it later during the school, during our classes in price action training school. So as for now, use it this way. It will save a lot of pips, especially if you do it on higher time frames. You will be much more relaxed. Dower is asking, well, it will be about scaling in. I think I have scheduled it for next month, but it will be in very soon, in a month. I think in a month or two, or maybe even this month. I take a look at schedule. It's scheduled on Admiral Markets website. I don't know. I can't remember the date, but I know that I have already scheduled it. Maybe even this month, but not sure. Don't take it for granted. Just check it on Admiral Markets website. Scaling in, yes, that's very useful. I will be showing you how to effectively boost your profits with scaling in. So guys, thank you for listening. I will be here with you. We had great going today. We had a New Zealand dollar, 50 pips gain, pound dollar, pound yen was a loss, but it compensated with GBP dollar, which was a killer trade. Thank you guys, and I will be here with you soon. Cheers, and as always, trade safe.